Oh, and then
by the second President Bush, because, of course, he was the leading political contributor.
Oh, my goodness. And what was his name?
Roland Arnall. He's deceased at this point. But this is what we do for our most elite frauds. We don't put them in prison. We get a minor fine that leaves them still multimillionaires, and then we give them our greatest honors and power because of the contributions. So that's the lead-in to the Clinton administration. But the first Bush administration had also been a leader in prosecuting the savings and loan debacle frauds, which is that era. Those huge prosecutions are occurring in particular in 1990, 1991, 1992, just as the Clinton administration is about to come in. They win the election in 1992. And so our agency, the Office of Thrift Supervision, not only had killed these liars' loans, we had made over 30,000 criminal referrals. And this led to over 1,000 convictions of elite bankers. The total convictions were over 3,000. I'm only giving you the 1,000 figure from what are designated as major cases. So these are big players, right? By the way, flash forward to the current crisis, same agency made 0 criminal referrals, and there have been 0 elite prosecutions.
You're listening to lawyer, academic, author, and former bank regulator William K. Black. Today's show, The Greatest Bank Robbery Ever. I'm Bonnie Faulkner. This is Guns and Butter.
Clinton administration does several things as soon as it comes in. First, it deprioritizes prosecutions in the savings and loan area. It moves the prosecutors to healthcare fraud. Okay, healthcare fraud is a very big problem, but that's the first thing that happens. The second thing that happens, and it happens very quickly, is that the Clinton administration embraces what was called the Reinventing Government Movement, which I think many people have forgotten about. So if you really hate Al Gore, conservatives, you should be very conflicted, because it was Al Gore as vice president who was in charge of this anti-regulatory movement. Mm-hmm. And this anti-regulatory movement led to sharp cutbacks in regulation, sharp cutbacks in supervision, and, as I've described, a sharp cutback in prosecutions of financial frauds after a while. And so I personally witnessed the regulators at our agency being instructed by Washington under this new Reinventing Government Movement that we were to refer to banks as our clients, and we were to think of them as our clients.
Wow.
And I, not being a quiet type, stood up and objected and said that our clients were the United States of America and the people of America. And they said, no, that's not correct. Right? Under new Reinventing Government initiative, the client was the banks. So this was a very hostile view. And so we call this the 3 Ds: deregulation, desupervision, which is the rules may stay but nobody enforces them, and de facto decriminalization. And the 3 Ds become very large under Clinton administration. That actually expands under Bush. And between that and what was occurring in executive compensation, we produced what we in criminology refer to as a criminogenic environment. And that's an environment where the incentives are so perverse that you produce epidemics of crime. In this case, epidemics of fraud by your most elite financial institutions.
And what government agency were you working in at that time?
At that time, the Office of Thrift Supervision. But what I'm describing was not limited to the Office of Thrift Supervision, although there is, and I understand this is radio, but there is a iconic image that does come out of the Office of Thrift Supervision, and your listeners can find it online even today if they look at the annual report of the Federal Deposit Insurance Corporation for 2003. It's a picture of the head of the Office of Thrift Supervision holding a chainsaw. He's standing next to the 3 leading bank lobbyists in America and the deputy head of the FDIC, who will become his successor as head of the Office of Thrift Supervision. The other 4 gentlemen are all holding pruning shears, and they are poised and posed over a pile of federal regulations. And if that's too subtle for the viewer, they are tied up in red tape. And the message, of course, is that they're going to destroy regulation, the rules, and the enforcement. They're going to work hand in glove with the industry, the lobbyists for the industry, to destroy. And Gillerin wants to signal through his holding of the chainsaw that he's going to be completely indiscriminate in doing so. Well, mission accomplished, guys.
Wow. Well, now, with regard to Gore's Reinventing Government, who was behind that? I mean, what was the main thrust of it? Was the whole idea to deregulate government, to get rid of it?
Not entirely to get rid of it. It was an academic idea, as all good ideas that are disastrous, they tend to come out of the academy. And it wasn't allegedly hostile to the government. It was reinventing it. But it did have this view that government was a failure, the private sector was a success, and the way for the government to become a success was to emulate the private sector, to embrace the private sector as all these public-private partnerships, and to tremendously whack back with a chainsaw at the role of government through privatization. So wherever possible, you ended the government involvement through privatization. Where it wasn't possible, you had to have government, well, you downsized it and you put it in partnership with business and instructed the governmental folks to treat the business as the client, as opposed to the American people as the client. So it was a disastrous approach that helped create this incredibly criminogenic environment. Now, I emphasize Gore at this point, but of course this was very much the Clinton philosophy, and it was the philosophy pushed by a certain governor of the state of Texas, who of course was George W. Bush as well. So this was one of those areas that was not partisan. Everybody agreed, except a small group of rational folks who said this is insane.
And this is sounding very familiar, because the same thing is going on as we speak.
Yes, and what Americans don't know is that this movement was every bit as effective in much of Europe. So Americans tend to think of Europe as this incredibly socialist, highly regulated place. And they forget that one of our leading exports even now is economists. Right? We train much of the world through our PhD programs. And so by this time, in the senior ranks, it is very common that you have the key technocrats have been taught with this anti-governmental economics out of the Chicago School and the Reinventing Government movements and such. And so the reports about the crises in Iceland and Ireland, and these are simply the places where the Europeans have actually done reports, emphasize that across the entire EU, banking regulation, largely disappeared. And even worse was the desupervision. So even when the rules existed, even when you found violations, there simply were no serious actions against the violators. And so, of course, between that and executive compensation, which Europe has also largely adopted from the United States, you created these intensely perverse incentives where you knew you could get away with fraud. You knew that fraud was a sure thing, that it would produce guaranteed massive but fictional profits, and that you knew that modern executive compensation would make you wealthy within a couple of years. Now, the firm might fail, but you would walk away wealthy. And this completely ignored real economics, and it completely ignored what had actually worked in the savings and loan crisis, and it completely ignored criminology as well. So in economics, the key article has a great title that explains it all. It's Looting the Economic Underworld of Bankruptcy for Profit. So the CEO loots the bank fails, that's the bankruptcy part, but the CEO walks away wealthy, that's the profit part. And this is not obscure economists, this is an article in 1993 by George Akerlof and Paul Romer. And George Akerlof won the Nobel Prize in Economics in 2001. So this is one of the most respected economists in the world who sounded this warning in 1993. And this article concludes with a paragraph for emphasis that says, in the savings and loan crisis, economists had no theory of looting. And so they gave no support to the savings and loan regulators who figured this out from the beginning about the fraud incentives. Now we know better. I'm quoting them. And if we learn the lessons that the savings and loan regulators taught us, then we need not have these crises. And what did we proceed to do? We substituted dogma about failed policies that actually produced the crises. We ignored entirely that which we know works. Instead of stamping out liars' loans when they came back, nothing effective was done against them. And so we don't know better, right? Well, we do, but the people making decisions who believe in this dogma, this theoclassical dogma, instead of any real world or any real world economics or any real world criminology or any study of actually what works as regulation. They know things that are not true. And that's the old line that is quite true. It isn't the things you don't know that cause crises. It's the things you do know but aren't true.
That's the best quote. I love that quote. It's the things that you do know that aren't so. Something like that. Yes.
That's right. And that, because it leaves you as a regulator fat and happy. You know that fraud can't exist. You know that markets exclude. You know that markets are efficient. You know that bubbles can't exist. Right? You know all these things. So why should you regulate? Why should you listen to the examiners who are finding the fraud in the field and trying to warn people up the chain? They don't have degrees in economics, doctorates in economics. They don't really know the revealed truth.
You're listening to lawyer, academic, author, and former bank regulator William K. Black. Today's show, The Greatest Bank Robbery Ever. I'm Bonnie Faulkner. This is Guns and Butter.